The lithium crash. Could AI see trouble before traders did? Picture a warehouse built for the future, not some dusty storage room with old boxes and bad lighting. I mean a clean, industrial space stacked with the materials that were supposed to power the next century. Battery components, mining contracts, shipment records, forecasts, purchase orders, all tied to one metal that suddenly became one of the hottest words in the global economy: lithium. For a while, lithium didn't feel like a commodity. It felt like a sure thing. Electric vehicles were coming, battery factories were expanding, automakers were making promises, governments were pushing cleaner energy, investors were watching the battery boom and thinking the same thing everyone thinks right before a market gets crowded. How could this possibly go wrong? And then the price started falling. Not a little. Not a gentle correction where analysts calmly adjust their charts and pretend they saw it coming. Lithium prices dropped hard after their 2022 peak, and by early 2025, Reuters reported that prices had fallen about 86% from that high. Mine closures started showing up around the world. The market that had been treated like a rocket ship suddenly looked like it had hit a wall. That is the kind of drop that changes the mood in a room. One day, lithium is the fuel of the future. The next day, miners are cutting production, projects are being delayed, investors are asking uncomfortable questions, and the obvious growth story suddenly looks a lot less obvious. But here's where this gets interesting. Because the long-term story was not completely wrong. Electric vehicles were still growing. Battery demand was still growing. Energy storage was still growing. The International Energy Agency reported that electric car sales topped 17 million worldwide in 2024, rising more than 25%, and global battery demand also crossed a major milestone. So this wasn't a simple case of everybody was wrong and the future was canceled. That's not what happened. The problem was more complicated than that. The world did need lithium, but the market may have built too much supply too quickly, at the wrong price based on expectations that were just a little too smooth, a little too confident, and a little too clean. And markets love a good story. They love a beautiful straight line. EV sales go up. Battery demand goes up, lithium demand goes up, lithium prices go up, everybody claps. Nobody asks awkward questions at dinner, except real life is not a straight line. Factories open at different speeds, mining projects take years, government subsidies change, automakers revise plans, consumers hesitate, interest rates make cars more expensive, inventories build quietly, battery chemistry changes. China's market moves differently from Europe's market, which moves differently from the United States. And suddenly, the story people believed starts drifting away from the data coming in. That gap between the story and the data is where AI starts to become very interesting, because a human investor may hear electric vehicles are the future and hold on. A machine does not care about the slogan. It does not care that lithium was on magazine covers. It does not care that someone gave a confident interview on television. It does not care that a company presentation had really nice graphics and the word megatrend in bold letters. It cares about patterns. Supply, demand, inventories, shipment volumes, pricing pressure, production announcements, factory utilization, earnings calls, analyst revisions, search trends, trade data, satellite images, commodity curves, battery sales, EV registrations. A human trader might see some of that. An AI model might see more of it at once. And that is the question at the center of this video. Could AI have seen the lithium crash coming before traditional traders fully accepted what was happening? Not because AI has a crystal ball, it doesn't. Not because algorithms are magic, they're not. But because AI is very good at something humans are not always good at. Noticing when the story people want to believe no longer matches the evidence underneath it. And lithium is a perfect case study, because if you only looked at the big picture future, lithium still looks strong. More EVs, more batteries, more energy storage, more need for critical minerals. But if you looked closer, the short-term market was sending a different message. Supply was catching up. In some places, it was catching up too fast. Prices were weakening, some producers were under pressure, buyers were not panicking to secure supply the way they had during the boom. And the market was slowly realizing that The world needs this material is not the same thing as this material should be expensive right now. That difference matters a lot. Think about it like housing. A city can absolutely need more homes over the next 20 years. That can be true. But if builders put up too many expensive apartments in one neighborhood at the same time, rents in that neighborhood can still fall. Both things can be true. The long-term need can be real, and the short-term price can still collapse. Lithium ran into a version of that problem. The clean energy story was real, the battery story was real, but the pricing got ahead of the balance between supply and demand. And when that happens, markets can turn fast. The tricky part is that humans are not just reading data. Humans are reading meaning into data. We hear a company say demand is still strong, and we feel reassured. We hear that EVs are the future, and we connect that to lithium prices. We see a long-term forecast pointing up, and we assume the current price should also behave. But AI does not have to be emotionally loyal to yesterday's narrative. If the data starts changing, the model can change with it. That's the advantage. And honestly, it's also the danger, because an AI model may spot a signal faster than humans, but that does not mean it understands the world better than humans. It may find a pattern without knowing whether that pattern matters. It may react to noise. It may overweight one source of data. It may see a correlation and treat it like a warning. It may be trained on a market that no longer behaves the same way. So the answer is not, let AI make all the decisions and everyone else can go home. That's how you end up with very expensive chaos and a meeting where everyone says the word unexpected a lot. The better answer is that AI can be used as a challenge system, a second set of eyes, a machine that says, I know the story sounds good, but the data is starting to disagree. And that may be the real build smarter lesson here, because in markets, business, construction, logistics, retail, and even personal decisions, one of the hardest things to do is question a story that used to be right. Lithium was a great story. For good reason. The world is electrifying. Batteries matter. Critical minerals matter. The IEA has said lithium demand rose nearly 30% in 2024, driven largely by energy applications like EVs and battery storage. But a great story can still become overcrowded. A great story can still get overpriced. A great story can still blind people to timing. And timing is where investors get hurt. Because you can be right about the future and still be wrong about the price. That's the uncomfortable part. You can believe in electric vehicles and still lose money buying lithium at the wrong moment. You can believe in clean energy and still misread a commodity cycle. You can believe demand will grow over 10 years and still miss the fact that supply is too heavy this year. That's not a contradiction. That's a market. And this is where AI becomes less like a fortune teller and more like a smoke detector. A smoke detector does not tell you exactly how the fire started. It doesn't know whether the kitchen is destroyed. It doesn't know whether someone burned toast or whether the wall is on fire. It just tells you something changed in the air. That may be the most useful way to think about AI in markets. Not as a magical prediction machine, as an early warning system. If lithium inventories are building while the public story is still optimistic, AI can flag that. If producers keep announcing output while prices are falling, AI can flag that. If EV demand is growing overall, but not growing fast enough in the places that matter for pricing, AI can flag that. If battery makers start changing purchase behavior, AI can flag that. If analyst language starts shifting from shortage to balanced market to oversupply, AI can flag that too. The model doesn't need to be dramatic. It just needs to be less emotionally attached than we are. And let's be honest, humans get attached. We get attached to trends. We get attached to predictions. We get attached to what worked last year. We get attached to the version of the future that makes our current decision look smart. AI doesn't fix that by being perfect. It helps by being annoying in a useful way. It can interrupt the comfortable story and say, "Are you sure?" That one question can be incredibly valuable, because markets often do not collapse out of nowhere. They usually whisper first. A price weakens, then another. Inventory rises. A company delays a project. A buyer pauses. A forecast gets trimmed. A government policy shifts. An executive says demand is still strong, but uses language that sounds just a little less confident than last quarter. One signal alone might mean nothing. But 10 signals together? That's where the pattern begins. And that's where AI may have an edge. Not because it's smarter in the human sense, but because it can watch more rooms at once. It can read more signals at once. It can compare today's market to thousands of prior patterns. It can notice that the words in earnings calls are changing. It can see that prices and inventories are moving in opposite directions. It can spot when social excitement is rising while fundamentals are weakening. And in a market like lithium, where the signals are spread across mining, batteries, cars, energy storage, China, Europe, government policy, and consumer demand that matters, a human expert might understand the industry deeply, but even experts have limits. They sleep, they specialize, they have opinions, they have clients, they have meetings, they have inboxes that should honestly be illegal. An AI system can keep scanning. That does not make the human useless. It makes the human more informed, if the human is willing to listen. And that's the real question. Not whether AI could see the lithium crash coming perfectly. Probably not perfectly. Not whether every trader who missed it was foolish. No. Markets are hard, commodity cycles are brutal, and hindsight has a nasty habit of pretending everything was obvious. The better question is this: could AI have raised the warning flag earlier? Could it have said, the long-term story still looks strong, but the short-term data is getting ugly? That is a much more realistic question. And the answer is probably yes, at least in theory. A well-designed AI system could have watched lithium prices, supply expansions, EV demand changes, inventories, policy shifts, and producer behavior, and flagged that the market was moving from shortage fear into oversupply pressure. That would not guarantee a perfect trade. It would not tell anyone exactly when to buy or sell, but it might have helped people ask better questions sooner, and sometimes that's the whole point. AI is not always valuable because it gives you the final answer. Sometimes it's valuable because it stops you from asking the wrong question. The wrong question was, are electric vehicles still the future? Because that answer could be yes, while lithium prices still collapse. The better question was, is today's lithium price supported by today's supply and demand? That is a different question, a sharper question, and probably the question more people should have been asking before the crash became obvious. Now, here's the twist. By 2026, the lithium story had shifted again. Reuters reported that lithium demand for energy storage was expected to grow sharply, and prices had rebounded strongly from earlier lows as storage demand and supply constraints changed the picture, which proves the point even more. This market is not a simple straight line. It's not, lithium is doomed. It's not, lithium goes up forever. It's a moving system, a living system. A market pulled between future demand, current supply, policy, technology, battery chemistry, production cuts, and investor expectations. And that is exactly the kind of environment where AI becomes useful, not because it replaces judgment, because it forces judgment to update. That may be the best way to think about AI in finance, construction, business, and almost everything else we cover on this channel. AI should not be treated like a boss. It should not be treated like a prophet. It should not be treated like a slot machine with better graphics. It should be treated like a very fast analyst that never gets tired, but still needs a human adult in the room. Because the machine can find patterns. But people still have to ask whether those patterns make sense. People still have to understand risk. People still have to know that data can be incomplete, biased, delayed, or just plain misleading. And people still have to remember that when money is involved, confidence is expensive. The lithium crash is not just a story about one metal. It's a story about belief. It's about what happens when a powerful future narrative runs into messy present-day numbers. It's about how markets can be right about the direction and wrong about the timing. And it's about why AI may become one of the most important tools for spotting the difference, because the next big market mistake probably will not announce itself with flashing lights and dramatic music. It'll start quietly, in a spreadsheet, in a shipment record, in a price chart, in a factory update, in an inventory report, in a sentence buried halfway through an earnings call. Humans may look at those clues and say, that's probably nothing. AI may look at the same clues and say, actually, this pattern has changed. And that is where the future gets interesting. Not because AI knows what happens next, but because it may notice when the present stops matching the story. So, could AI see trouble in lithium before traders did? Maybe. But the bigger lesson is not that machines are always right. The bigger lesson is that humans are often slow to let go of a good story. And in the lithium market, the story was very good. The future was electric. The demand was real. The excitement made sense. But the price? The price was telling a different story. And somewhere inside all that data, before the crash became obvious, the warning lights may have already been flashing. That's the build smarter takeaway. Don't use AI to replace your thinking. Use it to challenge the part of your thinking that got too comfortable. Because sometimes the most valuable thing a machine can say is not, "Here's the future." Sometimes it's simply, "Look again."